No other paper currency comes remotely close to being able to replace the dollar. That's pure fantasy. There is one thing that can replace the dollar that will at the end. That's a heavy yellow metal with a four-letter word.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion over in Singapore, where we want to help you truly secure your wealth. Keith Weiner, founder and CEO of Monetary Metals, joins us today. Monetary Metals is an investment firm that is unlocking the productivity of gold. Most people regard gold as a dry asset to lock away in a vault and incur storage fees, and many are waiting for the gold price to rise. And Keith and Monetary Metals are on a mission to change this. And we're delighted to have Keith Weiner join us once again today. It's time to saddle up and silver up for Keith Weiner. Keith, welcome back to SBTV. How are you doing?
Doing good. Glad to be back.
Glad to have you back on. You're one of the more colorful guys, so we're always glad to have you back on.
I,
Keith,
I try. I try.
you do very well at that. Yeah, I recently received an email from Monetary Metals with a link to a PDF titled How Not to Think About Gold. And I was curious to see all the mistakes that people make, including myself, when it comes to gold. Now, in the PDF, there were 8 most common wrong ways to think about gold. And we may not go through all 8, but first, I want to ask you, why did you and Monetary Metals want to do this project?
A big part of what we're trying to do is to help people see as clearly as we can. How things work, what's going on in the world. The world's a really messed up place, and it's more messed up than most people think. But it's messed up differently than many of its critics are often saying. And I really do think that it's just better for everybody. The sooner that everybody comes to, see what's really going on, the better it is. And so there's certain things that I write that I know are going to be very popular in gold circles, and there's certain things that I write that I know are not going to be popular. And I just sometimes maybe call me a little bullheaded, but I just put my head down and just charge forward. It's like, okay, I may not make a lot of friends with this, but it needs to be said because at the end of the day, the truth is what it is, and deserves to be championed. And I've spent a lot of time over many years studying about this stuff and thinking about this and traveling around the world. Um, Ironically, I think the last time you had me on your show, I was in Singapore, but we couldn't get together face to face. I was in my hotel room in Singapore, not in your studio. But I do a lot of travel, meet a lot of people, see how things are outside of America, which I think a lot of Americans can benefit from that perspective as well. I think I say this many times, and not necessarily sure I make any friends in America, but I think Americans understand gold the least of any culture globally because we Americans have been very fortunate in that we haven't had like a currency collapse or currency crisis. So Americans are very trusting of the dollar. Of course, the dollar being the world's reserve currency, uh, in a certain sense, deserves a certain degree of trust anyway. It's not going the way of the Argentinian peso or that sort of thing anytime soon. And but there's a lot of really funky counterintuitive things going on, including with gold itself. And so I've made a study of it, and I talk about it, and I write about it. And this article is largely a compilation of material that I put out, over many years. And ironically, I was just looking at it earlier today. One of the things that I talked about was the evergreen rumors that the dollar is going to be just wiped out or cease to be the reserve currency. And I must have written that in 2013 or 2015 or something. It wasn't related to the current rumors and allegations of that. It was a different set of stories at that time, and yet that it wasn't a new rumor even then. Those stories go back to somebody posted on Twitter. I don't remember who it was the other day, and had a compilation of like Time magazine covers, the death of the dollar, going back to like 1970. And so this stuff goes back to before many of the viewers were born. 1970. I was 3 years old, Um, and so anyway, we put it out, and we hope that people, enjoy it and learn a thing or two and ask more questions.
Right. Yeah. So this, I mean, we'll touch on the death of the dollar, and this is something that it's really not new. It's been on people's minds for decades. But I want to first start off with I'm a gold and silver guy, and my belief is that if the money supply grows, hey, this is great for gold and silver. Too much money printing will eventually bring on inflation, and the Fed will react, might overreact, bring on, say, stagflation, and ultimately a loss of confidence and purchasing power. And hey, precious metals will go up. Am I right to think this?
Well, the first question that I would ask is when you talk about a decline of the dollar and in the same breath gold going up, I always have to ask that. I have to be that annoying person who, at the risk of being perceived to be too pedantic, um, says gold is going up in terms of what? As measured in dollars, but the dollar's going down. So you have this thing that's, imagine you attach a GoPro camera to a brick and you throw the brick over the side of a cliff. And then from the vantage point of the brick, which is now in free fall, you're saying that the top of the cliff is going up, which is that's how it would look from that camera, right? Is that the cliff is, cliff top is rising. Is gold really going up? Is the dollar really going down? Um, and it isn't entirely a pedantic, um, exercise to do that. I think that the dollar falls, obviously, and the dollar is designed to fall. This is not a bug; it's a feature. This is on purpose. This is the whole bloody point of it. And if you read between the lines of, even Friedman, the alleged free market economist, and everybody else, they want to ease the burdens of the debtors. They want to encourage more borrowing, and don't worry, they'll bail you out by making the thing that you just borrowed go down in value, so you can repay it back cheaper than what you borrowed, which is really quite a destructive game for the savers. They're the ones who are putting up the credit. So anybody who's saving in dollars is getting screwed. And so instead of saying gold goes up, I would say if you buy gold, you're avoiding the ravages of the dollar. You're not joining that brick on its free fall down the cliff. You're standing safely back from the edge. Just standing there. You're not going up, but you're not going down, and that's equally important.
Yeah, that's I think what you just said there is pretty it's pretty interesting because if it is a feature of the dollar to where the dollar actually goes down in a sense, was this feature built in when, let's say, the dollar was gold backed? Was that still the intent?
No, I mean, when America was founded, and a lot of countries in the rest of the world at that time, um, money was understood to be gold and silver, like actual metal. And when you deposited your money, i.e., metal, in the bank, there was an understanding that you had a right to get that amount back. And the only thing they did at that time was they standardized the unit. So if I said I had $20 deposited in the bank, everybody would know that that was the same. If you had $20 in your bank and I had $20 in my bank, it wasn't like two different banks that have two different definitions. But it was along the lines of standardized weights and measures. There was a standard definition of a meter, a standard definition of a kilo, and a standard definition of a dollar. It was a measure of weight. It was X number of grains of gold or a different number of grains of silver. Um, but certainly post 1933, it became a the dollar became irredeemable to Americans in 1933, and in theory still redeemable by foreign governments. Uh, you know, Post 1933, although in the 1930s, for a lot of obvious reasons, they weren't. They were bringing more gold into the U.S. because the rest of the world was becoming very unsafe, and the U.S. was a good place to store it. But post 1971, when the other governments actually were redeeming their dollars, France very famously sailed a battleship into New York Harbor and offloaded pallets of dollar bills and unloaded much smaller pallets of gold bars. The U.S. government was like, "Hey, that wasn't really meant to happen," and then they temporarily suspended redemption of the dollar and gold specie and other reserve assets temporarily, as what Nixon said. in 1971, and after that, it's been completely redeemable. And that was the regime of fully irredeemable currency, and the whole world was now in on it post 1971. And so that's really, I mean, you could argue it began in 1933, but by 1971, it wasn't anything but, and that's when I would say, yeah, it was absolutely designed, intended on purpose. You had Milton Friedman, the alleged free marketer, with his so-called K% rule, that since he believed that the value of the dollar is inversely proportional to its quantity, so he wanted to increase the quantity by 3%, which he thought would decrease its value by a corresponding amount. It doesn't quite work, in that nice linear way as he assumed, but that was the intention. The Keynesians claim to be completely opposite to the Friedmanites, but they're almost identical. Everybody wants to debase it. And yeah, it's a feature, not a bug.
If you're enjoying this interview with Keith Weiner and I, please consider subscribing to our YouTube channel. And if you would like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. So, here's a tip. Anytime a government says temporary, it ends up becoming permanent. So, never forget that. But Keith, sticking with that article, so let's say although the money supply increases, those extra dollars they move into other things, even besides precious metals. So a lot of us, we expect, the money printing is supposed to bid up the price of gold, but it actually means that even though this may happen or inflation may happen, inflation sort of acts as a creature moving around the economy, maybe bidding up home prices, maybe gold. Knowing this, whenever we see that money supply go up, is it a signal to us that we should see gold rise?
Not necessarily. So, a couple of times over the years in our annual gold market outlook report, we've plotted different measures of money supply, or it should be really called quantity of dollars. Supply would imply flows, like wheat supply would be X number of tons per year or bushels per year. But dollars aren't consumed when they're spent, right? They change hands, and then they can be spent again and change hands again and again. So dollars are really a stocks, not a flows. Um, but we've plotted M0 or M2 or whatever against the gold price, and there just isn't really that tight correlation that people would expect. That's one of those counterintuitive things. Just doesn't quite work that way. Now, I'll offer an observation as an economist, which is if it were true that the value of one unit of the currency is 1 over n, where n is the number of units. So if you double the number of units, then each unit would be worth half as much. If that were true, the dollar has by far the greatest quantity of any currency out there. It's not even close. I mean, the next currency would be the euro, and it's a far, far, far lower quantity. If this relationship held true, then the dollar should have by far the lowest value, and that's definitely not the case. Um, so there's a lot of other things going on that uh, that really drive what is the value of the dollar, and quantity is not um, is it's not I shouldn't say it's not a factor, but it's not a factor the way people assume that it is. And you can have a situation where the dollar is going up in value. So that's the perversity, right? The intention is for the dollar to go down, and they'd like it to go down in a nice linear monotonic that is without any reversals. And for people that study math, um, slide. But the problem is in markets, as soon as anybody thinks something's predictable, they put that trade on with enormous amounts of leverage, and then they short the dollar and drive it down, further and further and further and spike it down. And then, of course, they have to cover, and then the short covering rally is vicious, and so you get corrections along the way where the value of the dollar is going up, and it can go up very sharply. Um, and That's not what the managers of the dollar intend. But they don't have as much power over it as they suppose, and they don't have much power over it as most people suppose. So you get volatility and gyrations and all kinds of weird things going on. Um, and so yeah, that relationship doesn't hold the way people would assume.
Would you say money creation is an ingredient to inflation?
It can, if you define inflation as rising consumer prices, it can. Um, but there's something much more important to that, which is the direction of interest rates. So a monetarist named Newt Wixell in the 1890s studied, quantity at that time. Of course, it would have been gold, not dollars, um, circulating, and expected to find a nice correlation between quantity and price at the price level. And that's not what he found. What he found was the interest rate correlated to the price level, not the quantity of gold at the time. And so later that was named Gibson's paradox, that prices correlate to interest rates, and then that seems to have been forgotten, and we're back to kind of a pre 1890s pre Wixellian understanding. We just think it's quantity. So when interest rates are rising, that means that the cost of capital for every firm is rising. And there's an axiom, or should be called an axiom anyway, that no firm can earn a return on capital less than its cost of capital, right? So suppose you're borrowing at 10% and you're only producing an 8% return on capital. That can't work. You're going to be out of business. And so as interest rates are rising, you have to liquidate and destroy firms until until you destroy enough supply that the few survivors can raise their prices such that return on capital is greater than cost of capital. And so rising interest rates is the process of supply destruction relative to demand, by the way, because we're talking about return on capital, not a quantity as such, but a relationship. And so rising interest rates causes and correlates with rising consumer prices, and falling interest rates correlates and causes falling consumer prices, because each drop in the interest rate, let's suppose you own a chain of hamburger restaurants, and you have 57 stores in your brand. You always have a spreadsheet in your back pocket, which is the 58th store that you would like to open, and that's, as an economist, I would use the term marginal. That's your marginal store. It's the one that you would open if either revenues would tick up, or profits would, or cost would tick down. And then, let's say the interest rate's 5%, and your spreadsheet shows red ink. It just doesn't work at 5%. Then they push the interest rate down to 4.5%, and when you recalculate at 4.5, the bottom line turns green. That says, okay, now this will be profitable. So with each downtick, it's a fresh incentive for businesses to borrow and increase their leverage and increase capacity, increase production, increase supply on borrowed capital, because when the cost of capital is going down, you can pull down the return on capital, you're going to get an increase in supply. And so that's very perverse. And of course, in a falling interest rate environment, quantity of dollars is rising rapidly. But if all those dollars are being borrowed for purposes of financing new hamburger restaurants and all the things that hamburger restaurants need, so you have plate glass windows, you have those ceramic tiles on the floor that look like fake wooden planks, you have hamburger grilling equipment, walk-in refrigerators, all that stuff, all the speakerphone stuff that they use for the drive-through window, all that stuff. Those companies are borrowing more to add more capacity, and so you see prices are soft or falling in a falling interest rates environment, even though quantity of dollars is rising. And of course, the price of gold can rise during that environment, because they're debasing or cheapening the dollar, but not in a way that can be measured in consumer prices. Does that make sense?
Yeah, it actually does. The part I'm thinking about as you're talking is as interest rates go up, businesses start to fold, things like that, and it's often been said that the Fed is picking or choosing winners and losers. So I'd like to know your opinion on that. Where we are seeing businesses going down, we are seeing businesses having to consolidate. Is this a part of the rising rates?
Absolutely. And I know many, I call them otherwise free marketers. These are economists that can tell you exactly what's wrong with the minimum wage law, rent control, food truck regulation, whatever. But when it comes to money and credit, they see a Fed, fixing the price of credit, and they think that's a good thing. And so they would bristle and they would say, no, 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 the Fed is only picking winners and losers. when it's, and then they draw some arbitrary line in the sand. If the Fed were directly buying the bonds of certain corporations and not others, that would be picking winners and losers. But what the Fed is doing now isn't. And I say, guys, look, if you wanted uh, a market process for determining winners and losers, which ultimately comes down to which firms serve the customer and which ones don't. The firms that are good at serving customers win, and the firms that waste their capital pursuing things that customers don't want are the ones that lose. The very purpose in creating a Fed is to politicize the process of picking winners and losers and to make it an non-economic but a political process. And so, yeah, absolutely, the Fed's doing that. They picked winners and losers with the falling interest rate. Any company that got wrong-footed for falling rates, um, got destroyed. And of course, after 40 some odd years of falling rates, every firm was on a footing for more falling rates, and every bank was. Then the Fed reverses it. Surprise, surprise, nobody's on a footing for rising rates. They'd have to go call up their dads and grandfathers out of retirement if they're still with us and ask, how did you guys deal with rising rates from 1947 to 1981? Because that is no longer institutional knowledge. All the people that were running the world in 1981 are obviously long since retired, and people don't remember that anymore. But yeah, absolutely, the Fed is doing it, and like any other politicized decision, let's just say the results are, destructive.
Okay, yeah, I could stay on this topic forever, but I want to get into a few gold and silver bits here. Um, Retail gold and silver products. All of us hear throughout the years that the U.S. Mint is out of Eagles, yet no change, no effect on the silver price. We've seen Perth Mint have low supply, Royal Mint low supply, Royal Canadian Mint low supply from time to time, and we never really see the price move. So why is that? I mean, if we keep hearing low supply, low products for us to have, why don't we ever see the silver price move correspondingly with this?
I think over the last, what is it, 6 8 months, the price of silver has kind of been on a bit of a tear, and there have been at least decent stretches of low supply of those products. So it isn't like it never happens, but there's certainly many times in the in we'll call it the long dark period after the price peaked in 2011 through call it 2018 2019, when every once in a while there would be a rush of retail demand, and supply of particularly the blanks is inelastic. It's capital intensive to produce blanks. Stamp once you have a blank, stamping a coin out of it's cheap and easy. You just need a die, which is a couple $1,000s, and a press. And presses are a dime a dozen. But the manufacturing of the blanks and the polishing, they're pretty high spec. Um, Little manufactured item that's capital intensive. And so if there's a temporary spike in retail demand, it's not like you're going to get this big capital investment in that equipment to do that manufacturing. And even if you did, ordering those types of machines would have lead times of months anyway. I would assume even a good time, even pre-COVID, it would be months. Now, who knows what it looks like. And so when retail demand spikes, you can pull all the coins out of the supply chain, and the supply is inelastic. But in terms of affecting the price of silver in global markets, you the supply chain of let's just call it manufactured 1 ounce minted products. That's like there's this ocean of silver liquidity out there, and you're tapping into that ocean with a thin little drinking straw. And yeah, you are sucking silver, but not that much relative to the size of the silver market. And so if that just persisted week after week, month after month, and you're just pulling as much silver as you could, yeah, you'd start to have an effect on the price. Um, but if there isn't really buying of silver, through other channels, even let's just say 100 ounce bars, um, there's only so much silver you're going to be able to pull through that 1 ounce minted product drinking straw.
Yeah, so I mean, from my understanding, also it's the bigger bars, the 1,000 ounce bars that really move the silver price if these really start hitting high demand and along those lines. And so I guess my question is, when we have things like these silver squeeze where we go in and we buy these 1 ounce coins, maybe 10 ounce bars, Are they really having the intent to hurt the bullion banks, the COMEX, which are dealing in 1,000-ounce bars?
That rumor has persisted for a very long time. Um, there's a guy I won't name, but he's on RT. I think he still is. Who had a campaign, I don't know, 10 or 12 years ago, buy silver, crash JP Morgan. And I wrote an article in response to that, basically saying, number one, you're not going to crash JP Morgan. Don't worry about that. Number two, nobody in their right mind would want to crash the banking system because that's going to lead to such a calamity. Anyway, he actually dropped the F bomb on my name on one of his shows after that. He got very, very angry with me. He's since moved on to Bitcoins. I don't think he cares about silver anymore. But I don't think that the bullion banks care because they're not primarily. I mean, I'm sure from time to time they take a proprietary position. Like anybody else in the business, they think they see an opportunity, they go long or short for a little while. But for the most part, the action of a bullion bank when it's acting as bullion bank, leaving aside its prop desk, is arbitragers. They see a spread between silver in one market, silver in a different market, and so, the biggie being spot and futures. So if the speculators go in and start bidding up futures, that widens the spread a little bit, right? Futures are being bid up, and so they can buy spot and start pulling that up and selling futures until they close that spread back down to wherever the marginal, profit is for them. A few pennies an ounce typically. Um, they don't care about the price. They don't have a giant naked short. I wrote an article, Ted Butler, when he kind of retired, I think he was the biggest silver, you know, price manipulation conspiracy guy out there. And he wrote this article and he said, "Look, I'm old. I'm retired now. I'm like this emeritus professor. I've contributed my body of work to the world, and in that spirit, I encourage thoughtful disagreement if anybody has any." So I said, "Okay, I'll take up the gauge." And in that spirit, we wrote something called "Thoughtful Disagreement" with Ted Butler, in which we published all the data we've been collecting. So we license um, a tick history database with sub-millisecond resolution of every bid and every offer on both spot and every futures contract going back to 1996. It's terabytes of data. It's enormous. And we showed the data and we set up the experiment and said, okay, whenever two theories compete, you want to find a corner case where they predict the opposite outcomes, and then you want to go find, observe, make an observation in the real world of that case occurring to see which way it went. And here it is. And if it goes in one direction, Todd Butler's right, it's manipulated, and the banks are short massive amounts of futures naked. If it goes in the other direction, then Keith Weiner is right, and the banks are arbitrageurs, not bettors on the short side. And with data, we proved that the banks are arbitrageurs, they're not bettors, and they don't care. Have at it. And in fact, like anybody else, bullion dealers are the same thing. They're not betting on pricing. They want volume because they make a little bit on every trade, right? So whether there's buying or selling, silver bullion makes money. It's what nobody wants is a moribund market where it just freezes up and there's no activity, no buying, no selling, no trading of any kind, and it's like close your doors and go home. The industry is dead. That's what the bullion banks don't want, and nobody else wants that either.
Right. Okay. I want to go back to the U.S. dollar, the death of the U.S. dollar. Is it something that'll take time to happen? This death of the dollar. Some people call it a dollar collapse. Is it something that takes time, or is it something that could really happen in overnight or a few days, a few weeks?
So, I like to quote Ernest Hemingway in one of his books. There's a character that asks, how did you go bankrupt?" And the guy answers, "At first slowly, then all at once." Um, these things take a long time. Adam Smith said there's a great deal of ruin in a nation, um, and things are more robust than you think, and they just take a lot longer than you think. And here we are, you know, after all the craziness of the response to 2008, still talking about this, 15 years later. And I don't think the ruin is been achieved yet by any means. I think at the end, yeah, it'll play out in a matter of weeks. But the question is, are we at the end? So I have a couple of answers to that. First of all, no, we're not at the end. That's number one. And the way you'll know we're at the end is when so it's a process of capital consumption, capital depletion, and there's still obviously lots and lots of capital. When that capital is depleted, when that capital is collapsing, you can see everything rotting, rusting, breaking, seizing up, turning to ruin, and we're just not there yet. Um, Number two, is there any paper currency that can remotely come close to replacing the dollar? No, there's not. Just in terms of their sizes and therefore liquidity is alone, absolutely not. Um, Ironically, people love to pick on the dollar and say it's about to collapse because there's so much data available about the dollar. There's so much information. Of course, a lot of it is negative. So people say, "My God, look at how terrible the dollar is." They're kind of, it's kind of like the error of thinking that, flying on an airplane is dangerous. So instead of flying from LA to New York, they drive from LA to New York. It's kind of a misestimation of one risk and an overestimation of one risk and an underestimation of another. Um, the same thing with looking at the dollar and trying to compare it to the ruble or the yuan or some of these other things. Those are very murky, opaque environments, and I don't think I would be saying anything unique or shocking to say that the data that comes out of China about their currency and their economy and a lot of other things is closer to propaganda than data. Um, and so, people then, oh, look at the dollar looks terrible by comparison, but that's actually not the powerful argument that people think that it is. There's all kinds of bad things going on in China. It's just that that information is suppressed, which, when it comes to reserve currency, does not argue in favor of the yuan. Now, the yuan also has capital controls. That's another thing that's incompatible with reserve currency. Um, if the Chinese people were allowed to freely dump the yuan, and they weren't risking their lives to do it every day, then we would find out where the yuan would trade. I think it would be rather a lot lower than the current level. But then I think there's two other things that are worth saying. One, the idea that all the dollars would come back to America is kind of a persistent one. People are picturing, like, imagine if these were not gold coins, but maybe cheap plastic coins like casino chips or something, and had no real intrinsic worth. And so when the rest of the world wakes up one day and the bubble bursts, then they put all those casino chips on pallets to come back to the U.S. It isn't really an accurate way of looking at things. The dollar is not a thing. It's not an object like that. It's a relationship. It's a credit relationship. It's a relationship of being owed. And so all through Europe, all through Asia, all through, I mean, the Middle East, Africa, everywhere in the world you can name, there are two parties, one that's creditor and one that's debtor, that have entered into these relationships to agree to borrow in dollar terms. And so they're agreeing to borrow in terms of a currency not issued by their local government, but issued by the US government ultimately. And how do those relationships all go away? Now, it's easy to think of the asset side, the owner, the creditor, the owner of that thing, could, in theory, dump his dollar and buy something else, although he'd wipe himself out to try. But how does the debtor get rid of if you owe $1 million, how do you replace your debt? What does that mean to replace one's debt? You can't. You owe it, and until you pay it off, there is no way. I mean, the creditor can sell to another creditor, so the creditor can change hands. You get a letter from the bank saying, "Please make all future payments to this new bank has bought your loan," or something. But if you're the debtor, there it is. Um, the other thing that's worth saying is that all the other currencies are dollar derivatives. The dollar is on both sides of every major balance sheet in the world, including the central banks. So the dollar is the asset that's backing all the other currencies. And I think we're about to find out in Argentina. I always talk about when a central bank is defending its currency peg, the way they do that is they're selling dollars to buy their local currency to keep it from crashing. Well, Argentina on Friday basically ran out of dollars. That's it, kaput. So now we're going to find out what's happening to the value of the Argentine peso. And it isn't going to be going up. It's not. The dollarization is, hey, happy day. We finally got rid of the dollars. It's more like, oh shit, we ran out. Now what are we going to do? Um, and so, for all these reasons, No other paper currency comes remotely close to being able to replace the dollar. That's pure fantasy. There is one thing that can replace the dollar that will at the end, but as I always joke on Twitter, ain't nobody want that. That's a heavy yellow metal with a four-letter word to describe it, and nobody wants that.
Yeah, I have a feeling that has something to do with what we recently saw in Zimbabwe, a gold-backed digital four-letter four-letter type of currency. So you would say that this may not be a good thing that people might actually want, even though it's gold-backed. It may not really be something you want if it's a gold-backed CBDC.
So I always have to ask when people use the word backed, what do they mean? And there's three different things that could mean. They could mean a price fixing scheme, where that government or its central bank promises to fix its currency at that level. And the problem is they don't really have that power. When the market moves against them, then they're just going to say, okay, well, we've abandoned that currency level, and now we have a new level. So there's no real credibility to it. There's no real teeth to it. It's just a meaningless pretense. The second thing they might mean is, hey, trust us. We, I don't know, just use the example of Russia, and everybody thought about a year ago that Russia was going to have a gold-backed ruble. Trust us. We have gold in a vault somewhere, which I'm not going to show you, and you can't have any of it, but backing the ruble at a rate of 5,000 rubles to an ounce of gold. And again, there's no real teeth to it. It's basically saying blindly trust us. And I think the ultimate bubble here is trust, blind trust in government. Government promises to do X, whether it's pay for your retirement, give you free health care, give you whatever, free education, free housing, free everything. And people are just like, oh, yes, absolutely. I believe this. And I think that's what's going to come bursting in the end is uh, is the trust. So if a government says trust us, we have this gold over here in this ratio, I don't think that's particularly credible. The third thing, which again, ain't nobody wants that, is redeemable currency, where they're serious about it and they say, okay, if you want to turn your currency in, we'll give you the gold. And the problem with that, and I'm half joking when I say it, nobody wants that, is that that has to be built from the bottom up. You can't just retroactively take this irredeemable currency that's piled up, after it's poured out of spigots over the last 10 years, 50 years, or whatever century, and just now declare it retroactively to be gold redeemable. A gold redeemable currency begins by deposit of metal. That if somebody trusts the bank or the central bank or whatever to deposit their metal because the paper is more convenient, and then they entrust them with a deposit because they know they can get the gold back if they need to. Well, nobody's prepared, no government is prepared to go through the long, slow process of earning that trust. They just want to skip straight to the imagined benefits of it. And, it doesn't work that way. There is no substitute for, I mean, that's what in a way, every vault, every depository is doing. That's what you guys are doing, right? With your vault program. That's what Monetary Metals is doing with our interest-bearing program, is earning that trust one deposit at a time, which is slow and difficult, and you have to keep doing the same. You have to do the right thing over and over and over and over again. And years later and decades later, you've got something, and everybody wants a quick fix. Well, that ain't gonna be quick, at the end of the day.
Yeah, I hear you. Last question, real quick here. So when we hear all of these de-dollarization news coming up, what should we think?
I think, as I said earlier, I've done a lot of travel, and I've met a number of people in positions of power. Now, not at the level of prime minister and not at the level of central bank governor, but in a lot of cases, people one or two levels down from that. And I certainly see everybody gets the dollar is not really good for them. I mean, Americans don't get that. Americans think this is wonderful. And the irony there is that the architect of this whole system at Bretton Woods was a man named Harry Dexter White, who was a Roosevelt administration apparatchik. Harry Dexter White was later proven to be a tool working for the Soviet Union. His goal was actually to overthrow and undermine and overthrow and destroy America, not to do America anything good. And so everyone assumes the system is good for America because it's bad for the rest of the world. It's this zero-sum thinking. Something's hurting somebody else, it must be good for you, which anybody believes that, I would say read Stephen Covey and he'll debunk that view. Um, but anyway, leaving that aside, even in countries that are allies with America, there's a great realization that the dollar is doing them no favors for sure. And I've traveled to a lot of other countries. Now, I don't generally tend to travel to countries that are enemies with America, like Russia. I've never been. Um, but, there's a lot of countries where they don't really want to be enemies with America, but they're not necessarily the closest of friends. Everybody gets it. The dollar is terrible as a matter of their own public policy. But everybody individually and those governments as well have to make decisions in the world as it really is. And those decisions always involve, if you need to borrow, money to get credit to build a big infrastructure project, you're borrowing dollars because you find that there's no real demand in your local currency for those things. Um, it's one issue. And then when you're putting your own, money into savings, or let's say you're running a pension fund. I've met pension funds in Southeast Asia, balance sheets denominated in dollars, not in local currency. And it's just it's you can call it the least dirty shirt, you can call it the world's reserve currency. I mean, all those things are true in different aspects, but the system is what it is, and if you want to do business in the world as it really is, then you don't. There's really no choice. And what is it, Tina? There is no alternative. That is really true in all this, and the other currencies are not replacing the dollar. There's no such thing as, okay, we're going to throw the US dollar over and replace it with Singapore dollars or yuan or anything like that. It's going to be gold in the end, and I'm not joking. Nobody wants that. I mean, even most of the gold, the gold bugs, the people that buy gold, don't even really necessarily want a gold standard. They're more like free gold people that want the price of gold rising in terms of currency. They want increasing purchasing power. They don't want to just own money that's going nowhere. They want to have something that's going up. And gold's going to replace it in the end because I love that quote from Winston Churchill, where he says something like, "God bless the Americans. After they've tried everything else, they'll do the right thing." That was his, not exactly a benediction, but and there was something to that. And I think God bless the world. After they tried everything else and nothing else, it's all failing. It is going to rediscover and return to gold, which is obviously, again, a big part of Monetary Metals' mission. And we have a specific vector of how we're doing that, which is using gold in finance. But be that as it may, and you know, it's going to be gold that replaces the dollar. It's the only thing that has the size, the liquidity, um, the demand, and it's the only thing that isn't a dollar derivative. It's the only thing that isn't tied to the dollar. So, in a certain sense, to say that the dollar is failing as measured in other currencies, it's kind of like saying that Apple call options. I'm sorry, that Apple shares are collapsing in terms of Apple call options. That it used to be a share of Apple went for 20 September call options, and now it's going for 10 call options. It's just a ludicrous way of even thinking of it. You've got the framing all wrong. You're not going to get anywhere with that line of thought.
Three key points I heard you say towards the end here is trust. Trust is basically an asset nowadays. Doing the right thing and gold. These three things stick out towards the end. Keith Weiner, CEO of Monetary Metals. Before we wrap up, can you tell us about Monetary Metals and maybe a little bit about Jeff Dice coming on board?
So we are the company that's all about paying a return on gold, paying interest on gold. We do that by financing businesses that either have gold inventory or gold income. And I want to kind of frame this in Steve Jobs terms. There's a rumor, and I don't know if it's true or just an urban legend, that somewhere in the early days of Apple, let's say 1983, they're releasing the new Mac computer or something like that, and the marketing people are sitting there and they're talking about 128K of RAM and 6 gigahertz processor, whatever, or megahertz processor, whatever it was at the time. He said, no, 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 this is all wrong. Stop. At Apple, we're not going to talk about bits and bytes. We're going to talk about why. And if that's true, then he was a bit early in 1983, and that wasn't it was ahead of its time. That didn't really work at that time. That came into its own much later, and Apple became arguably the world's most valuable brand. Much later. Monetary metals is based on a why. Why are we looking to pay interest in gold? Uh, we want to finance real production in gold, because it's finance that ultimately drives everything. The people that are putting up the money are getting paid a return on their money in money, which of course if gold is money, it should produce a return. And the businesses that are getting financed in gold are now looking for gold revenues rather than dollar revenues. So it changes the whole paradigm. That literally shifts the world. That one thing, when you scale that up, I think a good working definition of a working gold standard is when anybody who wants to can deposit their gold and earn interest on their gold in gold. When that condition is true, that's a gold standard. And you get all the other behaviors that you want. Things are priced in gold, people are paying in gold, probably not like carrying around purses jingling with coins anymore. We don't live in the medieval age anymore. It's going to be a swipe of a phone on a point of sale thing or whatever the latest technology is. But it's going to be gold ultimately changing title somewhere, not you know debits and credits of a government created script. And so we're doing this to make it profitable to invest in the gold standard. And so as far as Jeff, I'll let him. He's very articulate. I will let him speak for himself. But basically, he's been at a nonprofit, the Mises Institute, for a decade. And from my perspective, I think he saw what we were doing and said, "Wow, here's a for-profit way." And of course, Mises, Austrian School of Economics is all about bottom-up entrepreneurial free market, stuff. Here's this bottom-up entrepreneurial free market company that's moving the needle on, helping the world go to the gold standard more than, and not to put. I think the work of the Mises Institute has been very good, and they've brought a lot of people awareness of and real scholarship in Mises and Austrian economics. But there's a limitation what you can do in a nonprofit think tank versus what you can do in a for-profit business. And so I've been developing ideas around how I think every policy issue there should be for-profit businesses. So anybody listening to this, if there's an issue that you look and say, "Man, the government's just screwing this all up," and you could try to lobby the government, and good luck with that. Or you could try building a bottom-up entrepreneurial thing that makes a profit by fixing the problem, by arbitraging it away. And I think ultimately there's a great deal of progress to be made by doing that. And I think that was attractive to him. And he said, "Hey, you know what? I want to help this effort, go forward." So we interviewed him on our podcast. Well, there'll be a lot more material from Jeff as we go forward, and anybody interested can tune in to that and see what he says in his own words. I don't want to speak for him. I don't want to speak for anybody, but certainly not for him.
All right, Keith Weiner, we appreciate the time. Your unique views, your very candid views, which come from truth. So we do appreciate that, and I hope we can do this again soon.
Absolutely. Thanks so much.
That was Keith Weiner, CEO of Monetary Metals, sharing his views on gold. To follow Keith and his views, you can visit his website, monetary-metals.com, or on Twitter at RealKeithWeiner. If you like this interview, please subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.